Humana stock has just reported earnings and is crashing down 14%. It has been down as low as 18%. Is it now undervalued? Should we be looking at this as an opportunity to buy at a significantly undervalued price with lots of upside? We're going to take a look at their revenue, see how well this company is progressing over the last few years, as well as their bottom line net income. We'll have a quick look at the balance sheet, the health of the company, total cash versus total debt. We'll also see how well or how poorly they have performed versus their competitors over the last 5 years. We'll analyze their dividend safety. We'll look at some of their financial metrics to see if they are positioned for strength over the next 5 to 10 years. We'll also quickly talk about some insider selling by the CFO. We'll look at the institutional opportunities and ownership, whether or not they are increasing their stake. And we will run through how their earnings report was and why they have crashed so far down, nearly 20%. We'll also run them through the valuation model, getting to our intrinsic value, as well as what we see the acceptable buy price given our investor margin of safety. And as always, we will touch upon what Wall Street are forecasting for Humana over the next 12 months. So let's jump straight into their earnings, which did cause this huge sell-off. Now, the headlines we can see they did miss by 226. It doesn't tell the whole story, which we will just discuss now. And they did top on the revenue. So we can see for the fourth quarter earnings per share, they actually reported a loss of 11 cents per share. Now, this was $2.26 worse than what analysts were estimating at $2.15. So a horrendous miss. But what we can see is their revenue did come up top, 26.46 billion versus the consensus estimate of 25.6. In reality, that earnings per share is horrendous. Now, in terms of what they're guiding for FY24, it is $16 per share, which is interesting because the analysts had this at $26, so even their forward guidance has come down significantly. So yes, they did beat revenue, but that is really meaningless when you look at the earnings per share, which it was a horrific miss and a loss, as well as the fact that they are guiding much lower at $16 per share versus 26. Now, there could still be a generational opportunity here or a massive opportunity, so let's just discuss. Over the last year, now they are down around 20%. When the market opens, it will be going down even further, in my opinion. It is now a new 52-week low, given the last 52-week low from yesterday was $390. Now it's sitting at $345. The yield, in my opinion, now when the market opens, that will go up to over 1%, and that forward PE will come down from that 15 that we've seen. Over the last 10 years, this is a company that has been performing well, up 314%. Now, it doesn't include those dividends reinvested, bear that in mind. And we can see their all-time high sitting at $555 October 22. Now, in terms of top-line revenue, what we like to see here is 3 to 7% growth year on year. 57 billion reported in 2018. 93 billion reported in 2022. Now, that is positive. We do see increases, and what I like about this are those continued and consistent increases year on year. And based on the trailing 12 months, December 2023's annual report is expected to show 102 billion. So again, another increase. So yes, I do quite like their total revenues over the last 5 to 6 years. It has been increasing and it has been moving in the right direction. Can we say the same for the bottom line net income? Well, 1.7 billion reported in 2018, 2.8 billion in 2022. So even the bottom line has increased. What do we see? Well, we see an increase to 2019 and 2020 before a drop, in fact, consistently down to 21 and 22, although we do note that the 2023 is expected to be an increase from the previous year. So overall, both revenue and bottom line have increased over the last 5 years. We just note the inconsistencies. With the top line, we see consistent increase year on year. The bottom line net income, it isn't as straightforward. So total cash versus total debt. Let's have a look at the health of the company. 2.3 billion reported in cash and equivalents in 2018. 15.2 in their latest quarterly report. So their cash has increased significantly over the last 5 years, which is a positive sign. And when we compare that to their total debt numerically and directionally, what we can see here is it has increased as well from 6 billion to 12 billion. So their total debt, in fact, has doubled to 11 billion. But it is important to note, just one thing to point out, when we do look at that cash and equivalents, their cash balance is higher than their total debt, which is a very good sign. Now, in terms of looking at some of their competitors in the managed healthcare industry, we have CNC, we have Molina Healthcare, as well as a few known well others. Now, over the last year, this is total return, including those dividends reinvested. Humana is down 19%. Now, when the market opens, this will, in my opinion, make them the worst performing over the last year. When we extend that to the last 5 years, what we can see is that they are in actual fact up 39% in the middle of their peers. They will come slightly lower with market opening. But overall, not the greatest 5-year or 1-year performance. But as we always say, past performance is an indicator of future performance. Now, insider trading, what we've done here is looked over the last year, essentially buying or selling of more than 100 shares. Now, it isn't that important, just want to point out though, insider selling is never really a bearish signal. The reason for this, insiders sell for a wide range of reasons, personal, financial. Insider buying is bullish, that is what we want to see. It basically gives us faith that these internal management teams are buying because they see the share price increasing over the next few months, years, etc. But we will just point out the CFO did sell around 4,000 shares in May the 4th. So it was quite some time ago, and we can see she did sell at around $526 a share at a cost of 2.2 million. Just something to point out though. In terms of institutional ownership, well, that sits at 92%. 7.2 billion worth of sales by these institutions over the last 12 months. Double buying in the same period. So institutions clearly like this company. They have been buying twice as much as they have been selling. Q1 of 23 as well as Q2, there were some large buys by these institutions. Q3, we actually saw the opposite with more selling, and Q4, again, marginally more buying. As always, though, institutions buy. It isn't something we should essentially follow and copy, but it is always good just to include there as part of the analysis process. So in terms of the dividend safety, where we see a score of 99, very safe. I don't believe that will change based on the earnings today. Market cap, 50 billion. It is a large cap company. Now, recessionary metrics, well, they didn't pay a dividend in the last recession. They did have above average growth, but we can see they did trail the S&P's negative 55% return with a Humana recession return of negative 72. Dividend growth, now this is what I do quite like about this company. Double-digit growth last February, double-digit growth over the last 5 years, double-digit growth over the last 10 years. We are expecting an increase in the next few weeks, so it will be interesting based on the back of this earnings report if we will see a double-digit increase. I am personally hoping that is the case, and we can see they have been increasing those dividends for the last 11 years. In terms of dividend yield theory, well, it states the company is undervalued when the current yield sits above the 5-year average. Now, this doesn't take into account that very massive price drop that we did see today in the pre-market. So this will go even higher, in my opinion, over 1%. So this is a strong sign of undervaluation. Likewise, the forward P will go lower than what we see. And even at the current P of 14.7, it is an undervaluation signal. So we have a double sign of undervaluation. But as always, do bear in mind, we're not looking at any of these models in isolation, and we will draw conclusions towards the end. And we can see the healthcare sector P is much higher at 17.9. In terms of the free cash flow payout, remember we do ignore earnings. It is susceptible to manipulation by management through accounting. Free cash flow payout below 60%, my personal preference, gives me faith that management are able to offer those double-digit dividends we love to see. 2022 at 11%, 2023 expected 9%, 24 at 10%. Again, I would be surprised if we don't see a very strong, at the bare minimum, high single-digit increase to the dividend. Free cash flow per share, well, 8.10 in 2013, 27.40 in 2022, expected $40 in 2023. Now, we did see that the shares or earnings per shares was negative, so we will wait and see the full effect of that on 2023. But just something to consider. Hopefully that was just a one-off quarter basis and that the full year will be positive free cash flow. Sales growth, very strong to see. Double-digit increases nearly every single year. 2022, 10% increase to the top line. 2023 expected 12%. So they are growing their top line, and we did see in the earnings they did beat analyst estimates with regards to revenue. Total sales were 41 billion in 2013, 102 billion in 2023. So they are growing their top line very strongly over the period. And if you want some more good news, they are also doing share buybacks. They are returning excess cash to investor pockets, reducing the share count from 159 million to 125 over the last 11 years. ROIC for me and for those that do subscribe to the newsletter, you will know that the 10% minimum is what we look for. Gives us faith that management are able to effectively allocate their capital, and it's consistently above 10%. The last 3 years it has been increasing as well, which is very positive, and 17% is something that I do quite like seeing for a company. Operating margin, free cash flow margin, for this industry, this is a struggle to try and keep up to the highs we like to see of 12% and 5% on the free cash flow. So it is one that I would consider just to keep an eye on. The last 3 years have been consistently at 5%, and we do see the free cash flow margin in fact drop to 1% in 2021, although the last year is looking at 5%. So this is one area that I would say if you're an investor or you're someone who wants to add this to your watch list, just keep an eye on these operating and free cash flow margins over time. Now, this is a essential case study of the perfect net debt to EBITDA. So this is the earnings before interest, tax, depreciation, amortization. And what we're looking for here are the number of years it would take the company to pay off all of their debt net of cash on hand. So 2022, in fact, every single year, it wouldn't even take them 1 day. And what this signals is that balance sheet strength is very strong and also correlates to that very high dividend safety score. So lots of positives with Humana. Yes, they did have a poor earnings. So let's now jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And before we do jump into the valuation, just to let you know that we have released our first free weekly newsletter dropping every weekend. If you do want to grab a copy, do click on the pinned comment below. Completely free, and this week we are taking a look and doing a deep dive on an undervalued company that I do believe to be a strong buy. So let's jump into the valuation process. Now, typically Graham's valuation formula is the first model we'll use. However, for Humana, as their top line revenue is increasing double digits consistently for a long period of time, this model is a little bit irrelevant. So we'll jump straight into the multiples valuation. As we can see, it isn't just Humana that has been hit. Also, other companies in the health sector have been hit. And as we see, these are their live prices. So we get the PE multiples, the average PE multiplied by the earnings per share of Humana, to get an intrinsic value of $454, which is significantly above that market value, which probably will drop when market opens. So we have our first sign of undervaluation. As always, though, we don't look at any of these models in isolation, and we will draw conclusions towards the end. We then have the yearly dividends. As we can see, growth rate double digits every single year, 12.1% in fact as the average over the period. I've gone for 7.25%. Now, as always, if you do believe it is optimistic or overly underestimated, you can grab a copy of this model and play around with these numbers. We have another sign of undervaluation. We then move on to the DCF model with the free cash flows year on year. Average growth rate very strong. Forward looking, we've gone for conservative, below analyst targets. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash to subtract total debt, get to the equity value, divide by shares outstanding. We have an intrinsic value of $615. Again, another strong undervaluation signal. As always, the intrinsic value then is just the average of these three models that we've gone through for today. So in today's episode, Humana's intrinsic value is $525. As always, and if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list, do click on that pinned comment below. So margin of safety, as always, we start off with 10%, which we use if we believe it meets three criteria: wide moat, strong financial metrics, good forward-looking data. We can see it is a buy up to 10%. At 15%, still a buy, and we can keep going essentially until we see it's trading near the current value. So at 35%, $341. In fact, it is only a few dollars shy of $341. So there's near enough, in our opinion, based on our estimates and judgments, 35% margin of safety to the current value. What do Wall Street forecast? Well, they see up to 59% upside with a price target of $550 over the next 12 months. As always, these are just what Wall Street forecasts. Always do your own due diligence. In my own opinion, this is essentially looking like a very good value to buy this company. The metrics look very strong. Now, the only thing I would say to that, there are other companies that are also going down based off this earnings report. We have CI, Signal Group. We also have CVS, we have United Health, we have Elevance Health. For me personally, whilst I would add Humana or more shares, I will be waiting to see the full effects of the other companies. If they do drop further, then I will be looking to add more shares of quite a lot in the healthcare industry, as I do believe even before today's drop, they were looking like an undervalued sector and looking like some strong upside for the next 2 years. As always though, do let me know your thoughts in the comments below. Are you adding Humana after this massive drop, or are you waiting, or are you even looking to add other companies that have been affected like United Health or Elevance Health? As always, have a great day. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, I'll catch you all in the next one. Take care for now.